welcome to another Major Market Movements End of the Week Market Review for September 18th, 2015. I'm Quad G, and in this video we're covering the peripheral markets, the stock market, the bond market, the crude oil market, and we're starting off here with the Dow. And I think what you can see here is we had this impulsive move up, and then right here was the Fed announcement whipsaw, which was just enough to kick us out of our position. Obviously, with this type of whipsaw, the stop losses would have needed to been significantly higher, which just extends the risk that much more. So anyway, and that we got knocked out. And so since then, it looks to me as though the market is working on an impulsive move to the downside that could be ending soon. I think we've got wave 1, wave 2, wave 3, wave 4, and now working on wave 5 to the downside, which will probably finish up sometime early next week. And then from there, I think we'll end up seeing a small bounce up to fill in some of this damage here that we saw at the opening today. Come back up here, fill that in with a 3-wave corrective move, and then from there roll right back over and start heading back down again. Again, I think the stock market is still in the business of making these steady rounded tops, and like we've seen before, well, let's actually go back here. All of these tops, you see this roundiness, drop down, a bounce up, and then continue. This whole thing has been just a rounded over mess. And I think it's possible that we'll continue with the rounded pattern with maybe a smaller, a little bit more to the downside early next week, and then I'll pop back up, come up here, make a right shoulder. This would be a left shoulder. Make a right shoulder, and then turn right back down and start heading right down into the next impulsive drop. Also, if this was the point of recognition here, which I think it's a fairly good candidate for, we're not likely to see this kind of drop as furious of a pace to the downside as we go down into 4s and 5s. The wave 5s will probably be less intense than this move, is what I figure. The upper Bollinger Band did an amazing job of holding resistance, and yesterday we did see the inverted hammer candle. Today we see some follow through. Coming down here to test the backside of the 20 DMA, which was blown through a few days prior. So we're back testing that. That could be a key level support for the short term anyway, and for another little small bounce before turning back down. The week does close as a inverted hammer candle. Very clear, good positioning, very strong, setting a key high there at 16,933. So again, any pop-up that we see is going to be, the risk is going to be engaged against that key level of resistance at the high at 16,933. The EWO, not much to see there. We have moved up enough to where if we do start to see some lower lows in the price underneath 15,300 down into 14,000, it will more than likely start to set up some positive divergences in the EWO going on from there. So there is some good potential here for positive divergence building up as we continue to descend. I would expect at least maybe a double positive divergence in the EWO before we finalize a bottom. And same thing with the RSI. So this deep move down, pop back up. We're stalling right at the 50 line. Didn't even make it up to the 60, and then turn right back around here. Could build up some positive divergences to come. MACD, which really just means that there's plenty of room to the downside. I guess that's what I should say, is because we have the potential for positive divergences. That means that we still got plenty of room, technically, for some price movement to the downside. The MACD is open to the upside on the daily, and on the weekly is still very much open to the downside, so that's bearish. So still bearish picture for the Dow. Unfortunately, it did stomp us out. You can be right all day long on the direction, but if your trade setups are set in such a way that they get stopped out, well, that's the sad side of this as well, is that you can be right in your overall larger technical analysis, but still below the trade setup. So hopefully going forward we can, I can do a better job of getting us back into a low risk short setup if the market behaves like I suspect it might. Let's take a look at crude oil. That's weekly. Let's go to daily. All right, so the daily here, this is somewhat concerning, is we've got a couple days to the upside. We've got what could be a bearish harami here. We get some follow through to the downside that does confirm that potential. So that does set a key level of resistance right there at 47.78. And while we're below that level, there is some possible bearishness to the downside. The other key level of support is going to be the end of the triangle pattern, which was at 43.60. So I think we're still kind of in a tug of war while we're between those two levels, between 47.60 and 47.78. I do think because of the triangle, we could still see an impulsive move up from here into October. The 20 DMA is still a key level of support. You can see it's supported in the triangle. I'm expecting it to provide support here as well. Weekly looks like an inverted hammer candle, though not in the best placement. It's kind of in the middle of this previous congestion. Again, it just reinforces that top, though, is a key level of resistance at 47.78. EWO right there near zero line, very neutral. Parking right next to the 50 there on the RSI, very neutral there. MACD on the weekly, closing out nearly neutral on the weekly, that's neutral. And on the daily, we're still slightly open to the upside, so that's bearish, or bullish, excuse me. So overall picture, I'd say, is neutral to bullish while we're above that crucial 43.60 level. All right, let's move on to the LA wave charts. So here's the Dow using YM, which is the mini Dow futures contract, continuous contract chart. And we just got kind of whipped out of this position, darn it. And so the price came up, tested the upper Bollinger Band, which did serve as resistance, came up, tested the primary downtrend line, the dashed purple, and then created the bearish high hammer, gap down. We take out the last swing low, short-term swing low, there at 16,318. So this is all looking very bearish. I do think, however, that we might still see a pop up here to backtest this purple trend line and maybe fill in this gap, maybe right up here in about 16,600 level. And then from there, we could buckle back down. Take a look at the NASDAQ. Similar picture. Everything was moving up in this bearish wedge, nice and neat, and then we got the FOMC announcement, whipped us out, but did find some resistance right there at the upper Bollinger Band before dropping back down, closing the day as a overthrow inverted hammer, and then we're seeing some fall through to the downside today. The NASDAQ hasn't quite taken out the last swing low yet. That low is at 42.91, but it's fairly close. I think we could come down and meet it early next week, and then maybe pop up again to backtest the purple trend lines maybe, and then from there turn right back around and start dropping off into wave 5. BKX, on the other hand, behaved itself much better. The purple trend line did hold as resistance there. The contracting, actually this is a barrier triangle. There's a contracting triangle when both the upper trend line is pointed down and the lower trend line is pointed up. That's a contracting tri. A barrier triangle, however, has the upper side, in this case, because it's in a bear trend, the upper side is capped by a horizontal resistance point, A, B, C, D, E. Is this washed out as a triangle because we got the slight incursion above? I don't think so. I think it's erratic. I think sometimes when you get erratic market behavior that gives you quick intra-day moves that just shoot up for a few minutes and shoot right back down, I think in some circumstances, like this particular one, you can ignore it as breaking the pattern, for breaking the pattern. So I think I would still call this a wave E of 4, and now we're starting wave 5 down. And again, we blew right through this trend line, so I think we'll at least get a pop back up here to backtest this breakdown point at 71.29 at least. Maybe come up and give a formal backtest of the trend line as well. That's another possibility. And then turn right back around. All right. Let's take a look at the 10-year note. Now, this one really threw me off. Just, I don't know how to count this now. It was looking really like a picture perfect wave 1 down, A, B, C for a running flat, and then a nice impulsive drop that was completely countered with a shot right back up, another impulsive drive right back up. So it just doesn't match the pattern whatsoever. However, it does set a key level of resistance or support right down here at about 127.03. If we take this chart and go to the weekly, we'll zoom in here. You can see that last week we got the hammer candle. This week you've got the intra-week incursion below the hammer candle. So that's one of the reasons I was thinking this might be ready to fall off, because you broke the bottom side of the hammer candle. But instead we whipped right back around and produced a larger hammer candle to the upside. So again, not really sure what this market's up to. It may continue to climb a bit higher, maybe. Maybe give a better back test of the purple trend line. That's a possibility. Really not sure at this point. So I think it's best just to be out of it and just keep watching for now. But of course, with the hammer candle, you do have a key level of support there created by the candle. That low is at 127.03. 330 seconds. Okay, that's the same thing. This is the 30-year bond. Again, nice pattern, just blown out of the water here with this shot up. We do see the rule for breakout here. There's you've got this trend line, this orange trend line, tested once, twice, 3 times, and now fourth time provides for a potential rule of 4 breakout to the upside. Best to respect it and just stay out of this market for now. See where it goes. Crude oil count. This is the count that I prefer right at this point in time. While we're above that 43.58, 43.60 level, I think this could be just a sharp wave 2 down. Then we get another push up, some sideways chop into a wave 4 for a flat to alternate with the sharp 2. And then one more push higher into the lower 50 range at least for wave 5 of C. And then from there, we could see another move to the downside. And one of the reasons that I think that the price could continue up into October is due to the seasonality of crude right now, which you can see here on the 30-year seasonal chart. The price, the wind is at the back of the price, and could push it a bit higher into October timeframe, and that's where I think we could find another significant top and another drop to the downside into the seasonal lows well into February. Okay, that concludes my coverage of these peripheral markets on this September 18th, 2015. I hope you all have a grand weekend, and we'll be talking to you later. Adios.